Chevron is currently trading at a staggering 263% premium above its true mathematical value. At the same time, its revenue is quietly collapsing by over 10%. The market is blindly buying a war premium, ignoring a rotting core. But is this just a bubble waiting to burst, or is there a hidden strategy justifying this insanity? To find out, we have to look past the headlines. Chevron's price-to-earnings ratio has aggressively expanded from 18.5 last year to 29.1 today. Now, for those new to stock market analysis, a multiple expansion like this is something you typically see in high-growth tech monopolies, not shrinking energy giants. This creates a massive problem. This surge in price happened exactly while earnings per share collapsed from $9.72 to $6.16. Think of it like buying a rental property. Imagine the landlord tells you, the rent I collect has dropped by 40%, but I'm going to charge you 57% more to buy the building. You would walk away immediately. Yet, that is exactly what investors are doing with Chevron right now. This is the classic valuation paradox. The market has divorced price from performance. Investors are chasing the chart, assuming that because the line is going up, the business must be growing. But once you grasp fundamental analysis, you'll see the dangerous flaw in that logic. Price expansion without earnings support is just a change in sentiment, and sentiment is the most fickle asset class in the world. When the mood shifts, there is no earnings floor to catch the falling price. But to understand just how far we've drifted from reality, we have to look at the hard numbers that drive value investing. Benjamin Graham's valuation model is considered the gold standard for determining a business's intrinsic value, which is simply what the business is mathematically worth based on its assets and cash, regardless of the stock price. Graham's model pegs Chevron's real value at approximately $52.35 per share. Yet the stock is trading near $190. That is a premium of over 260%. Even if we use a more optimistic discounted cash flow model, the stock is still overvalued by roughly 20%. This leaves you with zero margin of safety. In a proper investing strategy, the margin of safety is your insurance policy against being wrong. When you buy at these levels, you are pricing in a perfect execution scenario. You are betting that absolutely nothing goes wrong. But here is the twist. Things are already going wrong. While the stock price climbs, the engine room is leaking. Operating expenses have surged by 28.3% year over year to $15.5 billion. We are looking at a scenario where expenses are exploding while revenue is contracting. This is the cost efficiency crisis. Sure, inflation is sitting around 2.4% and labor costs are sticky, but Chevron's internal costs are outpacing macro inflation by a factor of 10. This has compressed net margins down to just 5.9%. The market is ignoring this because oil prices are high. They assume high oil prices cure all sins. But the investor's lesson here is vital. Operational bloat is a silent killer. If oil prices stabilize or drop, this bloated cost structure acts as a massive anchor. You cannot cut costs as fast as the market can reprice a stock. So if the fundamentals are deteriorating, what is propping up this house of cards? With Brent crude surging to $103 and WTI hitting $99, Chevron's stock price has stopped tracking the company's performance. Instead, it's tracking the global fear index. We have reports of military strikes targeting energy facilities and threats to maritime passages. The market has priced in a war premium. This is why the price-to-book ratio is up 18%. Investors are paying a premium for Chevron's physical assets because they fear supply chains are about to shatter. The narrative has shifted from Chevron is a great operator to Chevron is a hedge against chaos. However, this is a binary risk. If you are buying here, you aren't investing in an oil company. You are betting on the continuation of conflict. If we see a de-escalation, or if Asian buyers successfully negotiate alternative supply routes, as recent reports suggest, that war premium evaporates overnight. The stock isn't rising on sustainable demand. It's rising on supply fear, and fear is a temporary catalyst. But the risks aren't just external. When we look at the balance sheet, we see a strategic shift that should make every conservative investor nervous. Long-term debt has skyrocketed by 94% this year. Now, usually you take on debt to fuel massive growth. But remember, revenue is down. At the same time, cash on hand has dropped into negative territory, and net investing cash flows have plummeted to a negative $4.9 billion. This is a capital allocation disconnect. Management is leveraging the balance sheet aggressively. They are spending cash and borrowing money, likely to fund long-term assets or share buybacks to artificially prop up that EPS number we discussed earlier. Think of it like a household that starts using credit cards to pay the mortgage because their salary was cut. It works for a few months, but it destroys your flexibility. With Fed rates holding steady above 3.5%, this debt is becoming expensive. If a recession hits, and with retail sales flat, the consumer is already tapping out, Chevron has less cash cushion to maintain its dividend or weather the storm. And speaking of storms, we need to look at what they are doing with the oil they have already pulled out of the ground. Inventory levels have grown by 7%, but the inventory turnover ratio has declined. Here is the grocery store rule of stock market analysis. If a grocery store is stacking milk on the shelves, but customers aren't buying it fast enough, that milk spoils. In the oil business, if you hold inventory while turnover slows, you are betting that prices will keep rising. But if the war premium disappears and oil corrects back to $80, that stockpiled inventory loses value immediately. It transforms from an asset into a liability. Now I know what the bulls will say. They will point to the Altman Z-score. And they are right about one thing. Chevron boasts a Z-score of 6.55, placing it firmly in the safe zone. This measures bankruptcy risk. It tells us the company is a financial fortress and won't go bust. But here is the trap, and this is the most important lesson of the day for your investing strategy. Safety is not the same as profitability. Just because a company won't go bankrupt doesn't mean its stock price can't be cut in half. The Z-score tells you the bondholders will get paid. It tells you nothing about whether you, the shareholder, are overpaying by 200%. You are paying a premium for safety that is historically unprecedented, precisely at a time when the business is becoming less efficient. So, let's tie these threads together. You have a company trading at an all-time high valuation multiple, driven by a geopolitical crisis. Underneath that cover, you have a business with shrinking revenue, exploding operating costs, and a massive increase in debt. The market is looking at the headlines. The smart money is looking at the margins. My ultimate verdict is this: Chevron has detached from its fundamental reality. The stock is currently functioning as a geopolitical derivative, not a share of a business. The war premium is real, but it masks a deterioration in the quality of earnings that any student of value investing or fundamental analysis would run from. That is why I believe that within the next 24 months, we will see a violent mean reversion for Chevron. When the fear trade unwinds, the market will realize they paid a tech stock multiple for a utility-like return. That realization triggers a repricing event that could wipe out years of perceived gains in a matter of weeks. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.